today's session is about home prices, homes, home sales, a little bit about a conversation about interest rates, but it's crazy. I don't know if you've heard what really drove this forward was I was reading, my Twitter feed, obviously, and the CEO of Redfin, I don't know, I forget his name, but he tweeted something out about they were talking about the housing bubble, and it was super interesting. Our CEO is revealing just how wild the housing market has become. I'm happy to share this with you, but I just want to hear a little bit about your update for the week. How's it been going? What's going
Yeah,
on with
yeah.
you?
All's good. I bought a house last month in the middle of this craziness. Thankfully, I bought it direct from my landlord, so not a bidding war. Got lucky. And I had my first house item, I'll call it, just thing that we had to deal with, which was a leaky sink. So thankfully, we'd been gifted nice sets of tools, a good drill from our wedding, so we were able to get it done. But faucet replacement.
I heard like literally every Southern California person is moving to like Phoenix.
There's a bunch of that. There's a ton of renovation going on. My brother told me that IKEA cabinets, if you want to buy them direct, are 6 or 8 months back ordered. Like if you just want to get a set of cabinets, you simply must wait.
I'm hearing all these statements from Toyota, from the 10K and like the transcripts. Oh, we had inventory of our chips. We were good. We're like safe. We don't have any issues. And then I talked to the salesperson, and then they're telling me, no, like short of inventory, like it's terrible. Just things aren't lining up, right? The salesman is telling me there's no inventory, and the transcripts are telling me there is inventory of chips and stuff like that. So
Two different
yeah,
audiences get two different stories. What did you expect?
exactly. Glenn Kellman, who is I think this Redfin CEO, posted essentially this tweet saying it's been hard to convey through anecdotes or data how bizarre the U.S. Housing market has become. And they talked about Bethesda, right? So Bethesda, it's interesting. I have a friend who lives in Potomac. I think it's like the town next to Bethesda. And she included her written offer, a pledge to name her firstborn child after the seller she lost. So there a couple of other anecdotes. There are more realtors than listings right now. Inventory is down 37% over 1 year. Like that's insane. Like how can inventory just disappeared? The typical home sells in 17 days. That gives you nothing for no time to do anything.
Wow.
You have to be literally on top of that. And then home prices, they're up. I have other type of data here, but I guess he's using Redfin data. And then the final piece, it says, and homes sell an average of 1.7% higher than the asking price. Like I've seen higher than that. 1.7% seems a little bit low. But at the same time, there's two cities in the US that have like completely different trends. One is San Francisco and New York. And it kind of makes sense. The two biggest or most expensive markets, there's an increase in inventory. I think it has to do also. I mean, there's a bunch of other trends that he doesn't go into. I think it's like an increase in crime in New York City, flight out to the suburbs. There's a lot of things going on, and like the increase in what do you call it? The work from home. New construction permits down everywhere, literally like everywhere, except for the areas where there's growth, right? Miami, Vegas, Greenville, Detroit. I think Detroit has to do with like a low base, and Knoxville. Lumber prices are up 300%, and they just talked about home buyers. A lot of them have bid for houses, not even seeing them. A lot of people are getting bigger homes but paying less, and then for those low tax states, they usually say for every 4 people who move in, there's one who leaves, and so that's Texas, Florida. I think Tennessee is also now there. The migration to lower cost areas has led to less workforce participation, because what it means is that you can live off one salary because you're living in a lower cost environment, and so one person can be at home, I guess, taking
Yep.
care of the kids or doing something else. And lenders are calling employers to confirm that home buyers are still have permission to work remotely.
Oh my
So you got
gosh.
due diligence there. So yeah, rates are lower, making that makes sense, right? Because interest rates have gone down compared to like 2 years ago.
Mm-hmm. there's a lot of insane anecdotes. I'm sure you saw that one about the one in Austin I'm gonna buy your next house too. One of my clients sent me that. That was wild. I don't even know what that means. Did you see that one?
No, I didn't hear
There was
what's
a
that.
realtor in Austin who said, we submitted an offer on a house. Someone else submitted an offer, much higher cash price, and also contractually agreed to buy the seller's next house.
That's insane. How do you buy the next house?
I don't know. I don't know. That's all that it said. I don't know how this works.
That's crazy.
But it happened. But okay, so we've got all these crazy anecdotes. We got prices up, up, and up. I feel like the narrative over the last, I don't know, over this year has been, this is fundamental, right? This is real. So there's a demographic
this is
boom.
definitely. I wish I'd had demographics. I'll probably show it in our next week's edition. But demographics, millennials are the problem is, and this is what I've been telling a lot of people who don't believe this is permanent, or permanent meaning like a 5-year trend. There was a time where boomers lived in the suburbs at a ratio of maybe like, I don't know, 1-to-1, along with the generation that came after, which is, I think, what's that generation called that nobody knows who they are?
Gen X, I don't know.
Yeah, Gen X, that one, right? Like it's like this. It's completely not heard of. It's because it's boomers and millennials. Like those are the two biggest.
Right.
Cohorts.
Yeah. Gen X is in between. Yeah.
But then over time, boomers have been moving out, and now they don't represent a big portion of that. So if they continue to move out, they're not going to move the needle anymore. And now the one who's really moving the needle is the millennials. They're just moving in like huge numbers, but there's no way to move in. And so as a result, now you have in the suburbs, at least in these areas, or in like the southern states, or like those low cost states, where your people when they decide to move, it opens up doors whether they're going to move to the suburbs or to the low cost states, but there's no supply, right? And that's the issue. It's a demographic issue right now that we have, that there's no supply, and there will be no supply in the next couple of years.
It sounds like you're saying maybe not this insanity that we're seeing where there's more realtors than houses and inventories stays just incredibly low. Housing prices up over the next few year period. It sounds like you think it's sustainable, ongoing, likely.
Yes, totally sustainable. I think unless you have a short-term blip in supply, I mean, a surge in supply, meaning like all those boomers who haven't sold in the last year or something, what we've been holding out, and now they finally say, okay, well, I'm ready to move out.
Time to downsize.
Down to dines, whatever it is, and they move further away or something, and then there's a surge, like a temporary surge in supply that will probably like bring a halt to the price increases. But again, like you have also like, look at this, the 10-year treasury rate, which is essentially a proxy for mortgage rates, just going down. If you want to halt the buying power of those millennials, you just have to raise those interest rates.
Yep. Quick move. Janet Yellen mentioned it once on one podcast, and the market freaked out, and she's not even in the Fed anymore.
This is the northeastern. I live in the Northeast, so U.S. existing home average sales price, it's up. Talk about inflation! Like this is up 112% over 21 years. I think we did the calculations, like 3.35%.
Mm-hmm.
Or a little bit more. No, it's a little bit more. I forget what it was, but it's above 3.3%. That's for sure. If your income is not going up by that amount, you're not keeping up with housing prices. Now, housing, like the affordability, sure, it could go up because interest rates continue to go down. So it's a little bit of a mix, but you're going to owe more. You're going to buy a much more expensive house in relation to your income than 20 years ago.
Yep, but that's offset with the low interest rates, right?
Correct.
That's why the percentage of total income hasn't changed all that much.
Yeah, we're going to see that in a couple of graphs here. So this is also the last year. Look at the increase in so the Northeast increased 10%. Okay, which is high, but not to the level of the southern states. Crazy, 17%. Just regular U.S. consumer prices. just spiked there. Think, how do you explain this?
Prices of things that people buy went up. That's my explanation. That's what this graph means, at the very least.
The other part is that you had a dip in the a dip in prices when the pandemic started, and now it's the 1 year anniversary of that, at
Mm-hmm.
least from a numbers perspective. And so if you're comparing year to year, yeah, prices are up. Like compare ticket prices. Can you imagine?
Sure.
Yeah, flights, car, yeah, fuel, right? The fuel. Remember, like the cost per gallon was like astonishingly low in April, May of 2020, and so you compare those two. I probably should have taken out food and energy probably from here, and you would have gotten the core CPI, and we would have seen that. But it's still up. It's just everything is up. I think it has to do also with all the extra income people are receiving from the government.
Are you in agreement with so the new mandate of the Fed? I don't know how new it is, but the Fed is more explicitly pro-inflation than they have been in a really long time.
I think it's the only way out of our debt spiral. I really do. Like if you haven't analyzed 5% inflation, you're assuming that it's like repaying your debt 5% a year. If the inflation runs very high and then interest rates are low, technically speaking, your dollar should weaken over time. What that means in essence is like Bitcoin prices should go up.
That's the only logical outcome.
Yeah, and so but on the same hand, it also means that asset holders will do very well, and people who rely on labor income, and if they don't have CPI adjustments into their income, they're going to start losing. What's interesting though, if you compare that to like what happened in the 70s, early 70s had a lot of inflation too, but for some reason they ended up being, the decade of most equality, right, between the wealthy and poor. I think it has to do more with tax policy than anything else. The next one, and this is what we talked about before, right? You could still have a higher prices of a house, but and the PNI so PNI is principal and interest payments. So the PNI has gone up, from 2012 to now. It's gonna double in a couple of years, I guess, if you extend it further. But as a percentage of income, they peaked out at like I think middle of 2018, and it has to do with interest rates. Interest rates have fallen off a cliff, and as a result, that has kind of like compressed the increase.
So total payments towards mortgages have increased pretty steadily as a percentage of wages, more less so.
I think this is fascinating, but the moment you have an increase in interest rates,
Yeah, it's a dramatic effect. But that's counterintuitive to me because of the amount of people who borrow on 30-year fixed mortgages. I guess that just tells you about the pace of turnover, right? There's a lot of new mortgages being written every day. So it's got a pretty quick effect. And then I guess plenty of people have variable rate mortgages as well.
yeah, I think people in these boom periods or low interest rate environment periods also they take out like the 10-1 arm or the 7-1 arm,
Mm-hmm.
just 7 years for fixed payments, and then it starts increasing, right? If the interest rates are higher. If you took out a 7-1 in 2009 and 10, the effect should have been in 2016, 17, probably like 18, because that was the housing recovery, or like all the mortgages got refinanced after the Great Recession. And I think that's what you kind of saw in this graph, right? There was adjustments in 2018, but on the other hand, I think even the lows of 2009, 10, 11 weren't as low as what they were post pandemic. And so again, you had a ton of people doing refinancing. Remember, like if you were hearing from the banks, they couldn't keep up with the pace.
Yeah, they even implemented a special fee for refinancing federally held mortgages in
Oh, really? I didn't know that.
Yeah, in late 2020. There was so much, the pace of refinancing was so high that before, I think, just November 30th of 2020, there was a special like a cutoff date where you got to get your refi done by this point, or you start to pay a fee, which is still in place now.
And so now let's move on to U.S. pending home sales year-on-year increase. It's dramatic increase, 23% on year-on-year. But again, you're taking the beginning year in this calculation will be the middle of the pandemic, so obviously will be high. But just from the anecdotes we're hearing, it's incredibly
Pending home sales, so that's just total number of homes that are under contract to sell. Doesn't that contradict the low inventory? It's low inventory, but there's a lot of deals getting done.
yeah. There's a lot of deals getting done. Literally every house that comes to market is probably selling at some price.
Right.
I just want to say another thing. Look at manufacturing new orders index, which is kind of like a leading indicator here
Leading indicator for what?
for manufacturing. So basically, this is a survey of new orders coming in.
Mm-hmm.
And it could be the trouble with this one is that it includes planes and defense.
Mm-hmm.
So it could be skewed a little bit, but I don't think Boeing is getting a boatload of orders. It's not, those spikes in the graph usually are well known in the Boeing. I think here it's like a continuation from the high of 68 that it had just recently now. Anything above 50 is expansion. And so 64 is actually a pretty high number. And just like if you look at the graph, it's been like it peaks, then goes back a little bit to 60, peaks again, goes back to 60, and now peaks again, and now it's going down to 64. I think the economy will be running pretty hot in the next couple of months, at least.
I dig it. Yeah, this doesn't mean all that much to me. There's new orders going into manufacturing that makes sense, and the snapback.
I think in the future what you'll see is a continuation of the growth in the industrial stocks.
Mm.
I think that's what this means.
Which have had a good year to date thus far, correct?
Yeah, especially around semiconductors. And speaking of semiconductors, here we have total vehicle sales. I don't know if you've heard the news about the semiconductor space, and essentially they're running at full capacity. And on top of that, cars require semiconductors. And I think what happened recently was that you had a pandemic, you had a bunch of car manufacturers cancel those orders because they thought the recovery was going to be like 2008, 2009. Slow sloping upwards recovery, and instead we have like a really quick snapback, and we're hitting pretty much multi-year highs in terms of sales of cars. These semiconductor orders, it takes time for them to fulfill them, and so right now they're running low. And if you talk to people who drive by usually through on their highway, and they drive by dealerships, they will tell you that the lots are a third full what they used to be.
Mm-hmm.
It's just inventory is very low, and this results in lower discounts for purchasers. So people are going to pay higher for their cars.
That's a big line item in the American household.
I think it is. So a lot of the income that they've been saving from, or money that they saved from not commuting or whatever it is, it's part of that's going to go away into cars.
Yep.
And the problem is I don't really understand who gets that portion, if it's the dealer or if it's the manufacturer. Because I know the manufacturer usually, gives the dealer, hey, I will give you MSRP.
Mm-hmm.
I'll give you $800 off of it if you can start liquidating the inventory.
Mm-hmm.
But they're not. I think they're not just doing that now, and so the dealers can't just discount the cars anymore.
Yeah, I don't know how that shakes out between manufacturers and dealers. I know they've got a highly symbiotic relationship. I know that the dealers functionally don't capture much of the economics of sale, but capture a ton of the economics of service. That's definitely how it feels interacting with my dealer. They're super, super hot on keeping you in the system service wise.
There's a ton of data, prices, demand, everything seems to be on fire right now, running on like 8 cylinders instead of 6 or 4.
What does that mean for our viewers? What should they be thinking about?
Number one, housing prices, tough. I don't know what to tell you. They're just going to remain high or go up higher unless you have a temporary surge in supply. Somehow it's temporary. So take advantage of that. Be opportunistic. In terms of cars, if you can wait. I bet you demand will start to inch down a little bit, and then there will be excess supply on the lots, and then the discounts will return. The problem is that if you're in like my situation where you need 2 cars, in terms of refinance, I would still go for it. Like things are going to change pretty quickly. Interest rates might go up. The final thing is watch out for industrial stocks in terms of like you might have again positive revisions from analysts. You might have, I think that they might outperform in the future. And this is speaking from someone who invests in the market. But you should definitely talk to your own advisor.